Good trading opportunities are as rare as they are profitable. Therefore, the art of waiting is an important skill that all high stakes traders need to master. But waiting does not mean doing nothing. In fact, whilst you are waiting, you can actually do a lot of work that will have a positive effect on your long-term trading performance. So, what should you do whilst you are waiting for a trade? Well, in my trading mindset masterclass titled Master Yourself Before You Master the Markets, I introduced the concept of the trader's pyramid. With a few adjustments to the trader's pyramid, we can devise a simple framework that will help us make good use of our waiting periods. So, when you are waiting for a good trade, the first thing you need to do is address any market trader issues. This relates to number one, closing any losing trades at an appropriate time. And number two, monitoring market volatility. If you would like to learn more about the best time to close a losing trade, then please watch my video titled 4 Unique Trading Lessons from Unknown Market Wizards by Jack D. Schwager. The required timestamp is 6 minutes and 5 seconds. I will leave a link to the video down below. With regard to monitoring market volatility, this is important because, number one, a gradual increase in volatility could be an opportunity to increase the size of a winning position. And number two, a sudden increase could be an opportunity for you to shorten the time horizon of a winning position. We will now shift our focus to risk manager issues. Within the context of our framework, being your own risk manager means asking yourself 2 questions. Number one, have I got enough of the right sort of risk exposure? And number two, if I need to increase my exposure to a specific risk, then how can I do this? The second question requires a good understanding of market behavior because recent price action can serve as a significant level of support or resistance. For example, suppose you want to increase your exposure to an existing long position. Let us consider 2 price action scenarios. Scenario A and Scenario B. In Scenario A, there has not been a lot of price action above the current market price. Therefore, it should be pretty easy to increase your long exposure. However, in Scenario B, there has been a lot of price action above the current market price. Therefore, we would probably need to postpone any increase to our risk exposure, at least until the market reaches price X. We now need to deal with trading desk manager issues. When you are waiting for a good trading opportunity, that is the ideal time to look at the overall structure of your portfolio. Naturally, you want to make sure there is some diversification within your portfolio. This will help to mitigate the problems of having a concentrated risk exposure. But remember, too much diversification will result in more bad trading decisions. However, the primary goal of being your own trading desk manager is to ensure you are diverting cash away from your losing positions and then reallocating this cash to your winning positions. When it comes to reallocating cash to existing winning positions, you should give priority to number 1, high performance positions, number 2, established positions, and number 3, positions that are not likely to encounter problems in relation to significant levels of support and resistance. After you have dealt with the price-related aspects of your trading, you then need to focus on your research. And the first type of research you need to consider is financial research. The term financial research pertains to economic analysis, participant analysis, and company analysis. So, you need to make sure you are up to date with all economic announcements, COT reports, and financial reports concerning any stocks you want to trade. When it comes to financial research, make sure to do your own homework. Compile your own data and analyze your own data. Do not listen to the opinions of other people concerning the data that you have compiled. In particular, do not listen to the professional pundits of the financial media. I outline the reasons for this in my video titled Habits of Successful Traders. The required timestamp is 1 minute and 30 seconds. I will leave a link to the video down below. Once you are up to date with your financial research, you then need to focus on your non-financial research. Non-financial research relates to important information that do not show up on any financial report. Non-financial research can be in the form of first-hand data, technology research, and new skills. First-hand data concerns gathering your own data in order to identify new trends. This is important because professional analysts at banks and hedge funds might be good at identifying current trends, but they are not good at predicting future trends. Technology research concerns learning some of the science behind a specific aspect of a business. For instance, let's say you want to buy an oil stock. If you took the time to read a few books about oil refineries and oil tankers, then this would probably give you an edge against 80% of oil traders. New skills relate to exploring different ways to improve your efficiency as a trader. This could include learning about coding, statistics, economic history, different languages, etc., etc. We will now shift our focus to administrator issues. Whilst you are waiting for a trade, you need to make sure you are up to date with all your trading paperwork. This includes journal entries, trade reports, performance reports, etc. If you would like to learn more about this important aspect of high stakes trading, then please watch my video titled Trading Journals and Administrative Systems. I will leave a link to the video down below. We now need to shift our focus to the psychological aspect of trading. When you are your own trading psychologist, you need to monitor yourself in order to achieve these two goals. Number one, ensure that your trading style is a good fit for your personality. And number two, ensure you are trading in a non-passive manner. This will help with your long-term trading performance. If you would like to learn more about trading styles and personalities, then please watch my video titled Types of Trader Personalities. If you would like to learn more about what it means to trade in a non-passive manner, then please watch my trading mindset masterclass titled Master Yourself Before You Master the Markets. I will leave a link to both of these videos down below. And finally, we now need to deal with non-trading issues that affect your trading. Being your own life coach means monitoring your lifestyle to make sure that you are getting enough sleep, eating properly, staying hydrated, dealing with any issues regarding your physical health and mental health, getting enough exercise, and scheduling time blocks on a weekly basis for fun and recreation. Final thoughts. As a high-stakes trader, the two most important skills you need to master are: number one, knowing how to deal with drawdowns, and number two, knowing how to deal with long periods of inactivity that exist between sporadic periods of high market volatility. If you can master the second skill, then you will be in a strong position to generate significant profits when the right trading opportunities occur. Thank you for your time and happy trading.